Good morning, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another one of these Monday market updates, 9 a.m. Eastern every Monday morning. Get you ready for the week. Stocks to watch, economic news to highlight. Got a great video for this week, an important video. Stocks have held up surprisingly well given the bank crisis, and growth stocks have even continued their 2023 rally. Bank bailouts by the Fed and the FDIC have not entirely calmed investors, but it has kept them from rushing for the exits, right? Unfortunately, what comes next, the government is going to be powerless to stop. Okay, providing those backstops for the banks doesn't change the facts that financial institutions, these banks, have become weaker, especially the regional banks. That is now going to flow down into the rest of the economy through lending to real estate, businesses, and consumers. It's something that very few people are talking about now, but in hindsight, over the next year, it's going to be something that pushes us into another stock market crash, and people are just going to look back and say, yeah, of course, that was obvious, that should have happened. So I want to talk about that today. Stick around. We'll talk about the market outlook for the week, stocks to watch, some of the economic news coming out this week. Before we get started, I do want to highlight a special offer from Seeking Alpha. Click through the link I'll leave in the description below and get 50% off their premium access. You're going to save $120 a year. It's less than $8 a month for that premium access, less than I pay for it. In fact, when I signed up, I used to write for Seeking Alpha way back in 2010. I still use the premium access for analysis and research for the videos. Some great tools here like company earnings reports, stock screeners, filters, a lot of great stuff to be able to pick those stocks. So click through the link I'll leave below. You're going to see all the features and premium access you'll get along with that exclusive offer. Save 50% and the lowest price you'll find online. Back to our main topic though, because what I'm about to show you, it could lead to a $2.7 trillion stock crash. $2.7 trillion in market value wiped out of stocks. I'm going to show you why this is going to happen, how to invest, some of the specific stocks I'm watching for that could help protect and even grow your money. Again though, if you just look at the stock market over the last few weeks or even back to 6 months to that October low, stocks have held up surprisingly well in what's really the worst banking crisis since 2008. The S&P 500 here in green, along with the tech-heavy NASDAQ index, the S&P 500 has managed to remain above that 3,900 level last week. That's still more than 11% above the 3,500 low reached in October, but it's going to get a lot worse. And just that resilience in the market, as well as valuations, just tell me investors are still holding out hope against a recession, or at least a mild recession if there is one. And that's always how it is, right? I've been investing for more than 20 years, 24 years here, folks. And that's always how it is, right? Those forever optimists in the market deny that a recession can happen this time, right? We're never going to have a recession until it actually happens. Then they're forced to admit that one might be coming, but it's only going to be a mild one until they're forced to admit that they're wrong on that as well. In fact, if we look at earnings estimates, here we are on FactSet Earnings Insight, great research tool. All you out there in the nation are going to recognize this one because I use it all the time. But here we have the analyst estimates for earnings of companies in the S&P 500. So that broad stock market index, the 500 largest companies in the United States. And here we see in light blue the estimates for 2023 and 2024 earnings. So this year and next earnings. Analyst expectations are still for $222 in earnings per share this year. That would be about 1.4% higher from last year. You could see here 2022 just closed up those Q4 earnings reports, and companies ended up reporting about $219 in aggregate earnings for that entire index, those 500 companies altogether. That is just not going to happen in a recession, folks. I'm about to show you why we're heading headfirst into a recession, but we do have data from Deloitte that shows the average recession knocks about 10% off of the prior year's earnings, corporate earnings, off of that $219 per share that was reported last year in corporate earnings. That put us closer to $200. Now, I have been calling for $210 in per share earnings for 2023. I'm still holding to that. I think companies can get to that point, but that would still be quite a bit below the $222 that they're predicting right now. And that's important because remember, earnings are just the core valuation of a stock, folks. When you buy a stock, you make an investment in a company, you take an ownership slice of that company for those future earnings. Those are your right as part owner of that company. You could talk about valuations, trends, you talk about all this other stock market analysis. But what it really comes down to is those future earnings of a stock or of the market as a whole. How much is that worth today in value? And that's what you pay for stocks. On $210 in earnings per share for the S&P 500, even at a still relatively expensive 17 times on a price to earnings basis. Okay, so we take that earnings estimate, we apply some kind of a valuation valuation multiple on it, like 17, 18, 15, okay, but 17 times PE ratio, so that would mean stocks in the S&P 500 would probably come down to about 3,600. They're right now at about 3,970, 3,950 on the S&P 500, coming down to 3,600. That would be a 9% drop from here, and that would wipe out $2.7 trillion in stock market value, and I'm going to show you why that's going to happen. First, if we look at a graphic here by the Mortgage Bankers Association, banks hold nearly half of the $4.5 trillion in U.S. commercial property debt. Okay, so that is any kind of property other than residential. You've got your offices, you've got your industrial, warehouse, self-storage, all that, hotels. That commercial property debt, $1.75 trillion, almost $2 trillion worth of commercial property debt held by banks. About $400 billion of it is maturing this year. That's going to need to be refinanced. Okay, so when somebody takes out a loan on a property, a commercial property anyway, a lot of times they'll just roll that over instead of paying it off. Maybe they'll just pay the interest payments each year, and then when that loan comes due, they'll refinance it. Okay, well, with about $400 billion of that maturing this year, going to need to be refinanced. Regional banks have always been the best place for these loans, okay? So because those regional banks, they know those specific local property sectors, so they've always been the go-to for this commercial property debt, for those property loans in that region. Obviously, those regional banks are very much weakened right now. They've been extending credit on that local property market. So they hold 27% of that debt. Okay, so that alone is going to be about $100 billion in loans maturing this year and need to be refinanced, held by regional banks. And of course, with the regional banks in a crisis and how really the entire U.S. banking system weakened right now, banks can't make those loans until they know exactly how much of their deposits they're going to be able to hold on to. Okay, that could mean a crash in the commercial property market. Now, over the last year, we've actually already seen the commercial debt defaults rates surge as property owners just let their properties default rather than refinance them into these super high interest rates, right? So the fastest interest rate increase in 40 years has already taken those interest rates up to the point where a lot of commercial property is underwater as far as, interest payments they have to pay. So what happens with commercial property, if you didn't know this, then most commercial investors, people that own these buildings, own these commercial properties, they have each building into an LLC, a limited liability corporation. So, you might have 50 different properties under your portfolio, but each one is an LLC. So you can let any singular one default, go back to the bank without really hurting the credit rating on all the others. Okay. Very common in property investing. We've already seen that with the office space, with the office demand down so much since the pandemic. Nobody's going back to the office right now, right? So a lot of these were already in default and going back to the banks. This financial conditions, as they tighten, those property owners might not be able to get refinanced on those new loans, even if they wanted them. Now, that's specifically in real estate, but we're seeing financial conditions weaken across the board. Financial conditions this month were the worst since May 2020, with banks reporting tightening lending standards just across the board. That's according to the Fed Senior Loan Officer Survey. Okay, so every month the Fed surveys senior loan officers, see who's raising tightening their lending standards, who's relaxing a little bit. And just over the last month, really even before a lot of this banking crisis happened, they saw the worst conditions since May 2020, the tightest conditions for loans. That is only going to get worse. Again, remember, the banks can't loan out money until they know that deposit base, those deposits aren't going anywhere, and its assets are going to cover the deposits. With that fastest rate increase in 40 years, it is estimated that there is a gap of at least $1 trillion in regional bank assets under their deposits. Okay, so those assets they have loaned out, they have invested in treasury bills, that kind of thing. There is a gap in value there of $1 trillion, so they can't make out any loans. And besides those real estate loans, of the $22.7 trillion in corporate debt rated by S&P Global, 8% of it is scheduled to mature this year. Okay, that is $1.8 trillion in company debt going to need to be refinanced this year. Okay, because again, much like that property debt, that commercial property debt, these companies, they issue debt, they issue those bonds, they make interest payments each year on those to keep up with the interest, but they don't make payments on the bond. When the bond matures, they have to repay the face value of that bond. They just refinance it. They take out another loan to cover that one. Well, just over the last year, those interest rates have surged. That's going to mean higher interest expense and a tougher, just a much more difficult refinancing market. 13% of this trough, 13% of this $1.8 trillion is already from companies already rated junk. Okay, those are companies already in distress. Now they're going to be paying much higher interest rates when they try to refinance this debt. So that's the real estate and corporate side of the economy crumbling. That last piece left is going to be consumer spending. That consumers make up 70% of the economy, and because of this strong jobs market, it's held up pretty well. That's the only argument the bulls have had for no recession. Okay, but those higher interest rates, tighter lending standards on not just corporate loans or real estate loans, but on consumer loans as well. It is going to be getting much harder to get any kind of a loan. That is going to change. Those corporations are going to have struggle under that debt, and that's going to change the employment picture as well. Unemployment is going to jump. It's going to scare a lot of consumers into saving instead of spending, and that's really the last leg of the economy that is going to be pulled out from under it. Of course, don't look for the Fed or Treasury Secretary Yellen to admit any of this, but Chair Powell actually forecast a recession a year ago, even though he's not going to admit it right now. In March of last year, Chair Powell, chairman of the Federal Reserve, said, frankly, there's good research that says look at the short end, the first 18 months of the yield curve. If it's inverted, that means the economy is weak. And what he's talking about here is the difference in interest rates between the short-term 3-month T-bill, that's what I've got circled here on the left, which is now at about 4.73%, on T-bills expiring in 3 months, maturing in 3 months, the government is paying 4.73%. And the 10-year bond at 3.78%. Okay, that's the one on the right here. That is a historic difference of 1.35%. Really, the clearest signal we have that a recession is coming. And so how you invest through this is going to be key, even for long-term investors. Nation, I hear it all the time, right? From investors that say, oh, I don't care what stocks are going to do from one year to the next. I don't care if stocks crash. I'm not going to try to time the market. I'm just going to invest and keep investing. And that is absolutely fine. That is a great way to invest if you can do it. But then they freak out as stocks start falling. Okay, they watch their portfolio fall. They freak out. They sell stocks as they crash, and they end up locking in those losses. Folks, being a long-term investor and just continuing to invest each and every month, same amount, just putting some money in your favorite stocks, even through a crash, that is fine. That is great investing. Like I said, even at these prices, you're still getting a good long-term deal. But you need to have the guts to stick with it and just keep on investing. Most people just don't have that, okay? Most people, they eventually panic. They sell out of their stocks. If you get stressed out with a stock market crash, you need to start protecting yourself right now. A few ways to do that. Number one, cash is still your friend, okay? There is nothing wrong with holding 15 or even 20% of your portfolio in cash, just waiting for those better prices. I have a lot of my cash in a T-bill ladder, a strategy that I described in a video just a couple of weeks ago. I'll link in the description below. Check that out. I also have money in a no penalty CD from CIT Bank. It gives me 4.1%. It keeps that money available with no penalty to withdraw it, get back in stocks. Both earn me right around that 5% return and just give me the flexibility to jump back into the market when I want, but not have to worry about that stock crash as it happens. You can also look to safety stocks or some of the other assets for protection. Stocks in the utilities and consumer staples sector is going to fall in a crash, but are going to hold up better than obviously those technology or the consumer discretionary stocks. Okay, this means stocks like Kellogg's, Colgate-Palmolive in the consumer staples sector. We'll look more at these in our sector outlook. NextEra Energy and NRG. These stocks are never going to make you rich, but they will lose less in a crash. They're going to pay higher dividend yields while you wait. I'm going to show you some more of those stocks here in a moment. I want to look now at some of the stocks I'm watching this week. Some of those will be the safety stocks that we're looking at to position for this crash. First, I'm looking at real estate stocks. These are down 25% in the past year. Really the worst performing sector, and could be in for more pain as we talked about. Okay, those higher rates have meant a lot of commercial real estate is going into default. Those bank lending standards are now tightening. So again, more than $400 billion in U.S. property that needs to be refinanced this year. 27% of that is held at regional banks and are going to be in no position to refinance. So there is going to be a crash in commercial properties, commercial property valuations. I'm looking at these real estate stocks. They're already down 25% in the last year, probably ready to lose more. So I'm not jumping in yet, but I would hold out on these REITs for the next 2 months, 3 months, but there should be some great deals later in this year. This is a great asset class. I'm watching for $70 a share, maybe $65 a share. That'd be about 10-15% further down on this iShares US Real Estate ETF. That's ticker IYR. That's good exposure to the overall real estate market in the US. Pays a 2.8% yield. As that comes down, that yield is going to go up to 3% and higher. So you're going to get great overall exposure to the U.S. real estate market, a good yield, and good price appreciation in the future. Cal-Maine Foods, ticker CALM, going to be reporting its earnings on Tuesday with expectations for $4.78 in earnings after a surge of 86% in revenue over the last year to $888 million. Okay, that jump in egg prices is starting to moderate, but it's been a windfall for this company, and shares are now trading for just 7 times on a PE basis, 7 times normalized EPS. Okay, so it's still some great value left in this stock. It is the largest producer and distributor of eggs in the United States, commanding 20% of the market. Okay, so this is the market share leader, has a great competitive advantage, fully integrated from feed mills to breeding, packaging, and distribution. This stock pays a 5.6% dividend yield. I think this is going to be one of the great safety stocks that we're talking about in all this. Okay, obviously that egg production is very safe and very stable. It's going to be a great stock to hold out and wait out the recession. EVgo, ticker EVGO, going to be releasing its earnings on Thursday with what's been just a challenging market for the electric vehicle space this year. Public charging has yet to benefit from that recent infrastructure bill, so I'm not saying in this environment to go all in just yet. I do own the shares. I'll probably hold some of my money, some of my investment on till later to see if the shares do come down a little bit. But still, revenue is expected to increase at this stock 119% this year to $50 million, up 215% next year to $153 million. EVgo is just the pioneer in the faster DC charging segment, and while last quarter's earnings have been a disappointment, the company is building out those partnerships and the infrastructure to be successful. So again, very challenging environment right now as the economic backdrop even gets weaker. These shares could weaken, but this is a great company, great long-term growth story as the country builds out its infrastructure, its charging infrastructure for electric vehicles. For our sector outlook, I want to highlight what the sectors did last week, as well as some of those safety sectors that you can look to in the coming stock market crash. We're here on the sectorspider.com. Great research tool here. The sector tracker shows you what these stocks in those sectors did over the last 5 days, year to date, 1 year, all of that. So 9 of the 11 stock sectors did close higher last week, with growth stocks once again outperforming. Again, holding up very well against this kind of environment. We haven't yet seen the recovery in energy and financials that I am expecting, but stocks in these two sectors, so we do see energy and financials did rebound a little bit, 1.2%, about flat for the financials last week after the big sell-off in the week before. But I am expecting these two sectors to recover a little bit just before over the next month, before the economy really starts to show those effects of the banking crisis. The entire stock market comes down. Once again, if we are looking for those safety stocks, though, you want to look at some of those sectors like consumer staples. You want to look at utilities. Obviously, both of these have very stable cash flows. They sell things that we have to buy even in a recession. So if you go through any of these, you click on their consumer staples, you can see which stocks are in those sectors. Obviously, you see things like General Mills, Kroger, ConAgra Brands, Kimberly-Clark, consumer staples. These are going to be things like packaging, food packaging, household goods. You got Pepsi in there. You got Clorox. You got Campbell's Soup. If you go to utilities here, you click on utilities, you've got Southern Company, Edison, you've got Energy, NextEra Energy. You've got all those utility companies in regulated monopoly spaces where they are making those stable and safe cash flows even in a recession. Check out that exclusive offer from Seeking Alpha for 50% off premium access, the lowest price you're going to find online, or click on the video to the right for the 7 dividend kings that will never let you down. Dividend stocks that have increased their payments for more than 50 years. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.